SPAC stands for Special Purpose Acquisition Company. Putting it in its simplest possible terms, a SPAC is a means of acquiring another company in a way that can bring swifter returns for investors than if they had taken a more conventional approach to acquiring the company. With conventional company acquisitions, known as an initial public offering or IPO, a company is audited and it files a registration statement with the appropriate exchange commission, such as the US Securities and Exchange Commission or the SEC, or the UK's Financial Conduct Authority or FCA, and arrangements are then made to list its shares on a stock exchange. But using a SPAC involves a different process. A SPAC is created by a team of investors in order to acquire another company. Let's call it a target company. Now, once incorporated, the SPAC undertakes an IPO and the shares of the target company are listed on a public stock exchange. But although the SPAC raises money through its own IPO, it has no commercial operations and no assets other than the money it raises through the IPO. The money is put into an account until those running the SPAC identify a private target company that could be suitable for acquisition. When the SPAC is created, its founders invest in it in exchange for preferred shares or founder shares. This initial investment may fund some or all of the IPO and usually leads to the founders keeping 10 to 20% stake in the SPAC when the IPO is completed. They'll often be on its board of directors and play a role in identifying acquisition targets. When a target is identified, the acquisition process then begins. And when the acquisition is complete, investors in a SPAC can either swap their shares for the shares in the acquired company or cash in their shares for what they would be paid for plus any interest accrued. The sudden increase in popularity of SPACs is the result of a number of factors. Firstly, the market for traditional IPOs has tightened as a result of the uncertain economic environment caused by the COVID-19 pandemic, leading many to seek different approaches, including the use of SPACs. SPACs give investors the chance to co-invest with founders who have industry knowledge, expertise, and access to possible acquisition targets that may not otherwise be available through the public markets. Low interest rates and the chance to take advantage of distressed markets have made SPACs increasingly appealing to investors. Finally, SPACs also offer a stable route to the public markets that does not lead to investors facing some of the obstacles they will encounter with a traditional IPO acquisition. While SPACs are attractive to many, there are risks associated with them, and I'll try and go through a few of them in this short time frame. So firstly, a failure to complete an acquisition within the designated time limit will see it closed, meaning there is no gain for those who invested in it. These time constraints may even create a pressure to complete an acquisition, leading to a far from ideal company being acquired, which could result in poor performance and weak returns or even losses for investors. It's important to note investors in SPACs are heavily reliant on the information provided by its founders, and so they are committing finances to a company that really they know very little about. The interests of a SPAC's founders may differ from the interests of a later investor, leading to disagreement and even litigation between the parties. misstatements in company registration statements, poor performance, and allegations of breach of fiduciary duty, fraud, market abuse, and even breaches of contract are some of the possible grounds for legal action. At this stage, it would be premature to make any predictions regarding the future popularity of SPACs in the UK. While there was a wave in the US, the UK has only just set out its stall to attract them to these shores. In April 2021, the FCA set out proposals for a more flexible listings regime that would bring the UK closer to the approach being taken by its major financial rivals. The ultimate aim was to lure SPACs to the London markets. Now, the FCA recognised that changes needed to be made to the UK listing rules if there was to be any chance of creating a market environment here that was conducive to SPACs. In July 2021, following consultation on the proposals, the FCA announced its new rules. And the rules laid down requirements relating to issues such as the minimum amount, which is 100 million, that has to be raised to actually fund an acquisition, ensuring money raised from investors, also known as public shareholders, could only be used to fund the acquisition of the target company and should be returned to them if no acquisition is completed. There's also a 2-year time limit for making an acquisition. A majority of shareholders needing to have to vote in favour of an acquisition as well. Furthermore, there's disclosure. So disclosure of any director's conflict of interest regarding an acquisition target is important. Investors being allowed to leave the SPAC before any acquisition is completed if they dislike either the terms or the target of the deal. So these issues need to be considered. There's also the disclosure of relevant information at all appropriate stages in the SPAC's development. A SPAC still having to contact the FCA before announcing an acquisition and show that it has met the relevant criteria, and that's obviously an important factor. What is important to note is the final rules came into effect on the 10th of August 2021. We now wait to see just how effective they are at attracting SPACs investment to the UK. A SPAC, as I said, must complete an acquisition within a set period of time. If a company is not acquired within this period, the SPAC is actually liquidated and investors have their money returned. As I have mentioned, SPACs are currently very popular, in the US at least. This popularity is reflected in the efforts that have been made to attract them in the UK. Yet an overly optimistic observer would expect the rise in SPACs to continue at the same breakneck speed. On one hand, the FCA's efforts may lead them to becoming a feature in the UK and could prompt the unprecedented levels of investment in them that have been seen on the other side of the Atlantic. On the other hand, however, we are not yet able to gauge just how commonplace or damaging the potential pitfalls I explained earlier may prove to be. With SPACs, for now at least, it's very much a case of watch this space.